chairman of this very famous institute, and which I'm very proud of. And that institute is actually one of the biggest institutes in Sweden and in actual industrial economics. Some 20 researchers and probably as many affiliates around the world. And our leader, Magnus, is sitting there. So if you want to have more questions about the institute, so please ask him. So you're heartily welcome. And it will be an exciting morning, and with this very inspiring headline, we will see what that means and what the conclusions will be. So don't rush away and sell all your stocks yet. We will have an exciting morning, and I'm also happy that an old friend, Mia Odavas, is going to moderate this. It was a long time we had the pleasure, so now I hand over to you, so please, Mia.
Thank you very much, Magnus. Let me bring my paper as well. Thank you. Good morning and warmly welcome. I would also like to say to you, of course, my name is Mia Odavas and I'm going to moderate this discussion. I have a business degree from Stockholm School of Economics a long time ago, and I've been working as a business journalist for many years, both in print, Svenska Dagbladet, and television, Swedish television, So I will guide you through this morning, and I really hope, as Michael said, that we will have a very interesting discussion. It is a very interesting headline, and maybe we'll see where it ends actually, if we will change the headline a bit, and if you will go out there selling all your stocks, or maybe do the reverse, we'll see. So we do have an interesting morning, and we do have ample time for questions and answers at the end in the panel discussion, so please just save all your questions and comments for a bit later on. We will start with a presentation by Alexander Ljungqvist, who is a professor in finance and entrepreneurship from Stern School of Business at New York University. And Alexander will give us a good background so we can pick what we like and discuss. And after Alexander's presentation, we will have comments by Börje Ekholm, who is CEO of Investor, and Magnus Billing, who is CEO of the Stock Exchange in Stockholm, or NASDAQ OMX. And after that, we will discuss. So please give a big hand to Alexander Ljungqvist.
All right. Good morning, ladies and gentlemen. It's a great pleasure to be here in Stockholm to talk about the decline and fall of the stock market. And to be precise, I'm not talking about falling share prices, so you don't have to sell your stock. I'm going to be talking about the role of the exchange as an economic institution. My argument is going to be that that role is changing in the economy, and that it's changing potentially for worse. And our purpose, I guess, this morning is to discuss and explore what the economic consequences of these changes will be. So we start by being clear about what the functions of the stock market are. Stock markets distinguish between two separate functions, two separate markets, the primary and the secondary markets. The primary market is a market in which companies raise equity capital, which are used to fund investment, innovation, growth, all the good things of the economy. And that we might call capital formation. The second function is to do with trading. And various trading activities that markets provide a platform for. So you have a market in which shareholders can buy and sell the securities, and thereby gain liquidity for their investments in companies. And at the same time, it provides an opportunity for households to cost-effectively diversify their investments. So that's a good thing. And as a byproduct of all this trading, we have data emerging, and in particular, we've got share prices being set on companies, which also provides a very useful function to the economy as a whole, because it provides price signals. So imagine a manager who's announcing a big acquisition or big investment somewhere. So we can read off the share price of the market, things off that, and that information is valuable in allocating capital efficiently in the economy. So these are all good functions. Now my argument is going to be that we are seeing a trend away from the capital formation side of the exchange towards the trading activity side of the exchange. And that will have economic consequences now and going forward. So let me set the scene by sharing some data with you. I want to start by thinking about how important the stock market actually is in the bigger context of the economy. We're going to start by looking at some US data. Perhaps surprisingly, in the US, most companies have nothing to do with the stock market. Most companies, in fact, in the US are not stock market listed. It's a tiny, tiny fraction of the universe of companies that ever listed on an exchange. Here's some data from the most recently available year, 2010. Of the 6 million or so companies that exist in the US, fewer than 4,000 are stock market listed. That's a vanishingly small fraction of companies. You might say that's very natural because large companies are listed and small companies are privately held. And that might be true in some countries, perhaps in Sweden, I don't know. But in the US, that would not be true. Even amongst the largest companies in the US, it is still the case that most companies are privately held and not stock market listed. So for example, amongst companies with more than 500 employees, which the US Census defines as the largest companies out there, fewer than 14% are stock market listed. Now collectively, all these privately held firms account for a very large share of economic activity in the US. They account for 2/3 of jobs, they account for 60% of sales, and they account for more than 50% of investment and of profits in the economy. So the vast majority of companies never get anywhere near a stock market in the US, and still they quite happily supply a very large amount of economic activity. Then if you look at stock market listed firms, then one of the surprising features that immediately jumps out of the data is that they don't use the stock market much to fund their operations. So stock market listed firms, in fact, rarely raise equity. Most listed firms never do after they go public. And those that do raise equity capital do so very infrequently. They're much bigger users of the bond market than they are of the stock market. The telling statistic is the fact that today, listed firms in the US obtain more equity capital through the exercise of their employee stock options than they do by raising capital from shareholders. Collectively, employees provide more capital to these companies than do shareholders. Then the final bullet point here talks about macro level. If you look at the flows in and out of the stock markets in the aggregate in the economy, you see that the stock market is a net use, not a net source of capital. What that means is that companies return more capital to their shareholders in the form of dividends and share buybacks than they raise from the stock market from investors. So collectively, there's a net outflow of capital from the stock market to investors and not the other way around. And the final point that I want to emphasize is that stock market listings and IPOs by implication have fallen out of favor, quite dramatically so in the US. So I'm going to share some data with you that illustrates this point. The first slide here shows you the number of listed firms in the US going back to 1925. So it's the total number listed in December every year. And as you can see, that peaked in 1997 at a little over 7,400 firms. And now it's down to 3,600 or so. So it's fallen by more than 50% in the last 50 years. And Magnus is very unhappy because this is his business. So the number of stock market listed firms in the US has never been lower than it is today in my lifetime. Okay? It's quite a depressing statistic. If you look at IPOs, it used to be the case that the IPO market in the US was the most active in the world. There would have been, on average, in a given year, around 400 companies going public every year. But since 2000, that average is down to below 100. So it's fallen from more than 400 to below 100 after 2000. It's a 75% decline in IPO activity. And at the same time as we've got fewer IPOs happening in the US, these IPOs are becoming ever larger. I'm showing you here is the average size of these IPOs by year. And as you can see, this is trending up. Today we have around 350 million IPO volume on average in a given year. And that's more than 3 times the average size in the 1990s, even adjusted for inflation. So IPOs are becoming ever larger, but ever fewer. That big spike in 2008 that you can see there, that's accounted for by one big IPO, which was Visa's IPO in 2008. Largest IPO in US history at that time, raising almost $18 billion. So the IPO market is perfectly capable of supplying very large amounts of money to very large companies. That is not the issue. There are other mega IPOs. Facebook would be another example, going public last year. Then of course this year you've got Twitter's IPO, which also was a relatively large IPO. So these things still happen. What is happening much less is small companies raising small amounts of money. That is the bit of the market that's slowly disappearing. To show that, I'll show you 2 slides. The first shows you the number of IPOs raising less than $100 million. It's an arbitrary cut, but it illustrates the point. As you can see, since 2000, that activity is draining away. So there's a huge fall in the number of small IPOs. And the second chart that I'm going to show you to illustrate this point is going to look at the share of IPO activity accounted for by different sizes of companies, in particular small and medium-sized enterprises. So if you look at the share of IPO activity of, for example, companies with sales less than 10 million, these are very small companies, less than 20 million or less than 50 million, then these very small companies used to account for the majority of IPO activity in the US until 2000, and since 2000 they accounted for much less, only about a third, rather than the majority of IPO activity. So instead now we've got large companies raising large amounts of money rather than small companies raising small amounts of money. So as I complete this slide, you'll see that the IPO activity is increasingly dominated by the larger firms in the economy. That's a big change. And then even venture capitalists who used to be heavy users of the IPO market are increasingly turning their backs on the IPO market. So traditionally, venture capitalists would have exited the IPO companies through IPOs. IPOs are shown here in red and gives you the number of IPOs, but number of venture capital exits of IPOs that would happen in a year in the US. But since 2000, the majority of venture capital exits would happen in the form of mergers and acquisitions rather than IPOs. So even these heaviest of users of the traditional IPO market have become less heavy users. All of this is contributing to a graying of the US stock market. US stock market listed firms are increasingly old and getting older. This chart shows you the average age of the company in the US. The number there for 2000 is 32 years, but today at 46 years, so an almost 50% increase in the age of these companies. So perhaps there's a decoupling of the dynamic part of the economy where new firms are created and the stock market where old firms are traded. Quick look at the Nordic countries. We get a very similar picture here. If we look, for example, at Sweden, here's the number of listed firms, not the number of IPOs in Sweden. That peaked in 2000 and is since down by 17%. If you look at Denmark, the peak was in 1990, which is a long time ago, and it's down by 39%. Look at Finland, the peak was in 2000, that's now down by 23%. And then the perhaps only exception is Norway, where it doesn't look quite so depressing, where the peak was more recently in 2008, and it's only down by 12% since. Look at the number of IPOs, that also looks somewhat depressing and discouraging. We're now talking about single digits of IPOs in the Nordic countries, so IPOs are becoming as rare as the fabled unicorn in the economy. All right, these exchanges are clearly not sitting on their hands, and I'm sure we're going to be hearing about what they can do about this in a little while. There have been a number of initiatives around Europe, but also in the US, trying to make IPO markets more attractive to smaller companies. There are just a few examples. For example, in September, NASDAQ OMX Stockholm released proposals for making the IPO climate friendlier to companies, in particular small companies, and perhaps we'll talk about that a little later as well. So these changes are clearly trying to fight back, and that's good. Now, what are the causes of what we're seeing here? We could spend the whole morning talking about the causes, and we won't, but I'll want to give you a little bit of a flavor. From an economist's point of view, what we're seeing is a decline in the demand for listings. As we have a decline in the demand, it's natural to think about there being a change in either the cost of listing or the benefits of listing. So let's think about the costs and the benefits having changed here. So on the cost side, companies complain a lot about the regulatory burdens that are imposed on them for being a publicly traded firm, and they're complaining about these regulatory burdens increasing over time. Just a few examples we could add to this list. There are ever more demanding disclosure standards, certainly in the US. The companies have to share ever more data with the investing public. There's compliance and compliance costs, therefore, with various laws and regulations. Sarbanes-Oxley, very famously, in 2002, made it very much more expensive to be a small publicly traded firm because the compliance costs are relatively fixed. They're not a problem for Unilever, but they would be a large issue for a small firm because they're fixed to a large extent. Dodd-Frank, this monster law that's reforming Wall Street, is imposing a very large number of new regulations on firms as well. Now, regulators and lawmakers are now becoming wise to the fact that this is having an effect, perhaps not a desired effect as far as listings and IPOs are concerned, and some of these reforms are now being rolled back. In the US, last year the Jobs Act was enacted, which is trying to make it a little less unfriendly to small companies, but we're only at the beginning of this deregulation, if you like. Europe is also moving ahead a little bit. So that's regulatory burden. Companies are also complaining about governance rules, which they consider onerous and which they consider increasingly onerous as time passes. I'll just mention two. Again, these are just examples. A debate at the moment that we see around the world is say on pay, should shareholders be involved in setting executive compensation? Some companies find that not a good idea. And a second example that I'll just mention briefly is what Ed Knight of NASDAQ calls expensive distractions in the form of proxy battles between shareholders and management and the advisory firms that advise shareholders in these matters. So being a publicly traded firm is associated with ever-increasing costs, which will hit disproportionately the smaller firms because many of the costs are fixed. That's one part of the equation. The other part of the equation is that the benefits of being a publicly traded firm may now be smaller than they used to be. So one of the big benefits of being a publicly traded firm is that you get trading liquidity. That's one of the points of being listed on the stock market. But we see trading liquidity being reduced for smaller companies. If you're a Unilever, it's not a problem. You're going to have a lot of liquidity. If you're a small company going public, it's not clear that there will be much trading in your stock. And that's to do with a number of things. One of which is that analysts increasingly ignore small companies. There's a stampede towards covering larger companies. You've got 50 analysts covering a large stock and very few analysts, if any, covering small stocks. And in connection with this reduction in the analyst attention to small companies, you have less attention from the institutional investors who feel that perhaps they don't want to hold companies that are not well researched. All of that then adds up to trading and liquidity in small companies. Another force here, which I think is very important, is that there's increasing competition for what exchanges have traditionally provided. So what have exchanges provided? Well, there's access to capital and access to trading. Now, if you're a privately held firm these days, you have more sources of capital to choose from than you used to, and those sources are becoming ever more competitive. You even have venues on which you can trade your stock without being a publicly traded firm. So the gap between being a public and private firm is narrowing in the sense that you have better substitutes than you used to as a private firm. You can even have your shares traded without all these regulatory burdens that there is governance rules. So for example, on the equity side, everybody's talking about crowdfunding these days. I'm sure that's true in Sweden as well. That's not going to be a substitute source of capital for Unilever, but it might be a substitute capital for a startup company. There are ever more sophisticated angels operating certainly in the US, and that's becoming true outside the US. That's another more competitive source of capital that's emerging. Venture capital, obviously growth equity and so on. So the provision of capital to private companies is being institutionalized and becoming more competitive. What that does is to narrow the gap between what the exchanges provide, the benefit that they provide, and what you can have as a privately held firm. On the debt side, the banks are becoming, seeing more competition emerging in the form of the US business development companies, which are much lighter regulated than the banks are. So again, the cost of capital is falling on that side. And then trading venues. If it's liquidity that you're after, you don't need to be traded on NASDAQ or the NYSE or Euronext. You can actually have your shares traded on a market that doesn't require you to be a publicly traded firm, and that it doesn't require you to do all the disclosure and corporate governance. In the US examples of that, the shares are closed and second. These are small, these are emerging, they may not get anywhere, but at the moment it looks like perhaps there's competition for the exchanges even on trading things. So let's talk about the consequences of all of this. If growth companies are turning their backs, as the data suggests, on the public equity markets, is that necessarily such a bad thing? Now, clearly it's going to be a bad thing for the exchanges, because their revenue from listing fees and ancillary services is going to decline. It may also be the case that if we've got fewer companies going public, a less active primary market, that the secondary market will, in the long run, suffer from that as well. Why trade anything if the exciting companies are not part of what you can trade? Perhaps. But before we shed too many tears, let's remember that innovation disrupting businesses is not a new thing. This happens all the time, and it's just part of the economic process. Just ask Kodak, which was undone by the rising popularity of digital cameras. Nobody shedding a tear for Kodak. The world is just moving on. So what we should be debating is not, this is bad for NASDAQ, the NYSE, or Frankfurt Exchange, or anything like that, but this is bad for the economy. So So I want to explore two potential negative consequences and then move on to a potential positive consequence. On the negative side, there is a cost of capital implication. If you're a privately held firm, it is still today more expensive for you to raise capital privately than it would be to access the stock market and raise capital that way. And if more and more companies choose to remain private, what that eventually will mean is that we have less investment, less innovation, less growth, less job creation, and so on and so forth, because those activities are financed more expensively. That is not a good thing. However, the cost of capital gap between the public markets and the private markets, I think, are shrinking. Not there where it's zero, but over time, perhaps we'll get closer to that. So this is a competitive advantage that exchanges have traditionally had, but it may be reducing over time. And the second potential negative consequence that I want to talk about is access to exciting investment opportunities. Imagine a world in which all the exciting investment opportunities that are emerging, the sexy companies out there, if you like, are never going to go public. Then as an ordinary investor, all you can invest in is the stock market, the old firms in the economy, the index, or something like that. Whilst the exciting companies of tomorrow are being funded by angels, venture capitalists, and hedge funds, and what have you, to which you and I typically will not have any access to. So we get a bifurcation of the economy where access to exciting investment opportunities is restricted to, let's say, the rich, and that may have negative consequences at a political level, where wealth inequality is increased, where public support, therefore, for shareholder capitalism might be undermined in the long run. So I'd be interested in your actions tonight. So these are the negative consequences, but something might be gained in the process as well. What I have in mind is that there are potential distortions induced by being a publicly traded firm on a stock exchange. And there's much debate about that in London, for example, these days, but also in the US. And I want to highlight two potential concerns that would lead to these distortions. The first is to do with the quarterly reporting cycle. A lot of companies complain about the fact that they're being held to account at a quarterly level when they release their earnings, when the earnings either fall short of or exceed analyst projections, and then the market reacts to this very short-term views. Now, in this kind of scenario, have managers becoming increasingly incentivized to focus on the near term as opposed to focusing on long-term value creation. There's a survey that was done of CFOs in the US that speaks to this point. And the conclusion from the survey, which is chilling, is that the majority of CFOs in the US, publicly traded firms, would avoid initiating positive NPV projects. These are the projects that we want to encourage. If that meant that the company would fall short of the current quarter's consensus earnings. So they'd rather meet analyst projections than build a factory that's going to produce something that's profitable. The second concern that I want to highlight is to do with communication between managers and shareholders. We have a lot of disclosure requirements at exchanges in the US, very high disclosure requirements, for example. And I wonder whether that might undermine firms' ability to communicate important changes in strategy or financial policy to the market. So imagine a world in which you come across a very valuable investment opportunity that you'd like to pursue, but pursuing it would require you to cut the dividend to fund that investment opportunity. Now, as a privately held firm, you would just get your shareholders in a room, you've explained the investment case to them, and hopefully they will sign off on the plan. So you cut the dividend to make the investment. But as a publicly traded firm, you can't get your shareholders into a room. So then what can you do? If you cut your dividend, then the market might panic because it would interpret this dividend cut as being bad news, and it might be hard to convince the market that it's actually a good idea to go after this investment opportunity. So then, in order to make sure that investors don't panic, you might start revealing a lot of information about the investment case to your investors. But at the same time as your investors are listening to the investment case, so are your competitors. You can't specifically target your message to one particular audience. So there's a mismatch here between what public and private companies can do on the communication side. The attractions of private ownership then are that you get more patient capital with a more long-term orientation, and that you get to have a more private dialogue with your shareholders potentially. I want to finish by showing you a little bit of data on a comparison of the investment behavior of public and private firms that came out of a study that I did last year. And because McKinsey's slides are so much nicer than my slides, I thought I'd show you their version of my results. So what this does is to compare the investment behavior of public and private firms that are matched up to be of the same size and operating in the same industry. So these are identical firms, if you like, except that one is public and the other one is private for each of these pairs. On the left, you're looking at the investment rates of these public and private companies. And as you can see, the public companies, which are the little ones here, invest much less every year on average than do the private companies that look similar to them in terms of size and industry. So private companies, let me say that very clearly, out-invest public companies, and that's despite the cost of capital disadvantage. It's a very surprising finding. On the right, we're looking at the responsiveness of investment to changes in investment opportunities. So this is the idea of, if you have a valuable investment opportunity emerging, do you go after it or do you not go after it? The higher the bar, the more responsive you are. The highest bar is for the private firms, the smaller bar is for the public firms. So as investment opportunities improve, it's the private firms that go after those improved investment opportunities, not the public firms. And the difference is gigantic. This is, again, very surprising. So the takeaways from my introduction to our panel discussion are, first, that I think there has been a decline and fall in the listing side of the stock market. There's a dramatic decline in demand for listings. Companies increasingly don't use the capital formation function of the stock exchange, not in the US, apparently not in the Nordic countries either. And perhaps surprisingly, in fact, there's more capital formation happening in private firms than we do in public firms, despite this cost of capital disadvantage. Does it matter? Well, if you think that stock markets are the most efficient way of supplying capital to companies, then it does matter, because there's a cost of capital difference between them. But this gap may narrow over time, as I was arguing, and that, I think, is a structural change that will erode the exchange's traditional competitive advantage on the listing side. And the second worry that I have is that access to interesting investment opportunities is increasingly focused on a very narrow segment of the economy, let's call them the rich, so that ordinary investors perhaps find it much harder to participate in the wealth creation of innovative firms going forward. They're not there now, but we might get there in the future. But the flip side of the coin is that perhaps private companies are a more suitable organizational form, more suitable way of organizing economic activity if you want to encourage long-term thinking and long-term investment. So on that note, I'm back to the moderator.
Thank you very much, Alexander. Let's give him a hand. Very interesting presentation, Alexander, and we'll pick up a lot of things that you have been saying. Just one question for you before we take up Börje and Magnus. You've been describing this quite dramatic decline, as you write and say, but I know that the Stockholm Exchange will actually tell us what they're doing about this, and some companies are on their way into the Stockholm Exchange, quite a few actually, in the coming 6 months. Do you see any change in this trend that you're describing?
I don't think so. I think there's it's too soon to say that there's a change in the trend. So if you read newspaper stories, you'll hear a lot about Twitter and other companies that are on the way to the stock market. I believe NASDAQ is going to have this year its first year without decline in the number of listed firms. Okay? So it's going to go up a little bit this year, and that's great. But remember where we're coming from. We're down more than 50%. It would take a lot of these stories, and therefore a very long time, for us to get back to where we were. We're at 50% below the peak of 1997. The economy is vastly bigger now than it was back in 1997. So this looks more like a structural change rather than a cyclical change.
Okay, so it's a long way to go.
Yes.
Come back and then go forward. Thank you very much, Alexander. We'll soon be talking to you again. Now, please welcome up Börje Ekholm, CEO of Investor. We give him a hand before he starts.
Thank you, and thank you, Professor Ljungqvist, for being here. It was a very interesting presentation. I had a couple of remarks, and of course, for Investor as a company, we have 75% of our assets in listed holdings, so the stock market is indeed very important to us. But I'm also the chairman of NASDAQ OMX, so in that sense, I think it's I have a vested interest, I'm sure, you can argue, in the stock market. I do think the stock market is a very important part of the economy and serves and will continue to serve a very important role in the economy. And the reason for that is, of course, to provide equity capital to growth companies. And I think that's often forgotten when we look around. We talk about capital formation, and it's too much focus on the debt side. But if we want to have equity capital into companies, the stock market is a great source. And many growth companies will actually start out being cash flow negative. So the growth companies, to provide financing for them are important. And I took up a couple of statistics. If you look in the US, for example, growth companies represent 1% of all enterprises, but they actually create 10% of all new jobs. And as a matter of fact, 92% of those jobs were created after the companies went public. So it's hard to dispute the fact that the public market is very important. The other piece of data comes from Sweden, which is from the NASDAQ OMX study done earlier this year, when we looked at listings on the First North since 2006. It's about 100 listings, and the average job creation in there grew by 37% per year after listing, compared to 2% for the general private enterprises in the economy. So again, showing the importance of the stock market. I also think there are a couple of other things that's kind of interesting, and that is what I often call independent capital. Because it's interesting to see venture capitalists, private equity, providing capital for growth companies. They will almost always do it with an exit horizon in mind. So there will be a need for an exit. And that exit, historically, as Professor Ljungqvist showed, have been the stock market. Today, it's increasingly M&A. So those companies are sold into bigger enterprises, where all of a sudden they are not standalone anymore. So just think about it. What would have happened if Apple had been sold to IBM in 1980 instead of going public? And maybe IBM would also have bought Microsoft in 1986 when it went public. Would have been a very interesting world. Would we have had a smartphone today? It's also interesting just to look at the statistics on the Apple IPO, which was 1980. They raised less than $100 million. That was a large amount, because that was the biggest IPO, as far as I have been able to see, since 1956, when Ford went public. So of course, it is interesting to think about it in that perspective. The value created in Apple came long after the IPO. I would say today, I think in less than a day, Apple has more sales than they raised in their IPO. So, where do I think the issues are here? There are, and again, Professor Ljungqvist pretty much, I think, hit on the most important items. But I'm going to hit on a couple of other things. One is, I think there is a lack of research on smaller companies today. So, if you go back 10, 20 years, we had quite a number of smaller brokerage firms that focused on following small cap firms. In the US, we had Ljungqvist, Robertson Stevens, and there were, I think they were called Gang of Seven or something. But they worked almost exclusively with growth capital. Most of those have disappeared over the last 10 years. They've been gobbled up by big banks. And why did this happen? I think it's the rise of electronic trading, actually. Reg NMS in the US and MiFID in Europe actually has removed all margins and driven the brokerage industry into scale. So that's going to happen, that's inevitable, those structural changes happen. But somehow we have to get back to some sort of basic research coverage of companies. Otherwise, it's going to be very hard for smaller companies to go public. How do we create that? I think that's worthwhile to discuss, because I don't really know the solution. But I think this is a huge problem, actually. The regulatory burden for listed companies are increasing all the time. All the political regulation that is directed towards companies focuses almost exclusively on listed companies. So if something is important for society as a whole, I think it should apply to both listed as well as unlisted companies to create a level playing field. Otherwise, we have a public corporation being at a disadvantage at all times. And you see that in whatever it is, the EU Green Book, for example, targets governance in public corporations. You see the diversity question that I think is a very important question, not to say that, but it focuses exclusively on public corporations. And we can go through this one by one. There is even in EU a directive being reviewed that you would have to report as a public company sales and income statement on a country-by-country basis in your annual report. Think about that for a moment, about the extra burden put on a public corporation. Then I do think we also have to get less focus on the quarterly reports. And I know this is a heated debate. And I want to put it this way. I don't think it's the work necessarily that goes into the quarterly reports that's the key here. Because most of the data in a big company today, you actually have it on a monthly basis or weekly if you want, or daily if you want so. That's not the big issue. The big issue is when you put it all together and it has to go into a report that's verified in quality, that certain is 100% correct, etc. That requires a lot of burden or effort. And the next part is you have to worry the whole time about what the media will say and the analysts will say and what the stock market will react. So you do spend a lot of time crafting the messages also. And I think that drives itself towards a very short-term focus. And it puts the company often on a quarterly clock. That may be right for certain companies, but it may not be right for all companies. I also think that we need to get back to regular shareholder. So the individual shareholder. We have institutionalized capital quite a lot. And when we do that, I think we have to evaluate our institutions based on some performance cycle. Whether that's going to be quarterly, that's quite short term, yearly, or maybe 3 years. But I'm willing to bet it's longer than it's shorter than the investment horizon for an individual shareholder. So therefore, I think we have to get back a lot more individual shareholders into the stock market. How do we do that? It's probably through tax incentives, thinking about how the tax system works. And then finally, it's very hard to isolate macroeconomy from how the stock market performs. Maybe it's right to take away the general economy, I don't know. But in reality, we live in a very doped world right now. We have the lowest interest rate situation that we've had for a long time. So, are we doing the right thing looking at capital formation today versus in a more normalized interest rate environment? I don't know. But I do think that plays a role, because raising equity capital or raising debt capital has probably never been as easy as it is today, and as cheap as it is today. So of course you can substitute equity with debt today. But the question is, can we do that tomorrow? And tomorrow we may again need the stock market. Thank you.
We'll soon be hearing more of you, Börje. And next to Magnus Billing, what is the Stockholm Stock Exchange doing? Thank you.
Thank you very much. We feel very alive today. We are not feeling at all dead. Very interesting presentation, Alexander. Thank you for that. We just turned 150 years old, so we've been around for quite some time. I think we will continue to be around for many more years to come. I think, as you said, Alexander, it may be too soon to conclude that the trend has been broken, but clearly we are seeing a much higher interest in going public today. We are seeing that already this year, and I think we will have a good end of this year on the main market, and I'm looking forward to 2014. However, it's fair to say, obviously, that we have had a number of difficult years in the past. I think they need to be put in context, though. I think looking at the last 10 years, we've been through an IT bubble, we've been through a financial crisis, which we hopefully will never experience again. And we SME change is clearly affected by the macro environment, as Börje said. That is one of the key factors deciding the attractiveness of the market. So we have to live with that, and therefore I think it may be too soon also to conclude that the change is there based on that time period. I also think it needs to be distinguished a bit between the main market and what we call the growth market, the First North market. Because I would argue that the First North market has been successful even during these tough years. Successful in the sense that we've been able to attract companies to come to our market, raise capital for the growth and job creation. And 2013 has also been a good year from that point of view. The main market has been struggling a bit more, but I'd like to come back to the First North market because of the 100, little bit more than 100 companies we have in First North, we have a healthy process for these companies in the sense that they're growing and then moving over to the main market. So during the years, the last 6 years, we've had 30 companies move from First North up to the main market. I know they're not considered as a listing in the media perspective, but we think that's a great success when we grow the First North, move on to the main market. So on average, we have 5 companies coming over there. And as Börje mentioned, the statistics for these companies when it comes to job creation is fantastic. So I think the change has an extremely important part to play in this context, and we continue to do that. I also like to point out that although we've had a few IPOs on the main market, I think we should not forget the secondary public offering happening. In 2009 and 2010, looking at those OECD figures, the exchange functioned very well in supporting companies raising capital to get through the tough years. We had a peak in those years when times were pretty tough. And I think that's evidence that the exchange has a very important role still in these days to support companies capital raising, growth, job creation. We're also seeing regulatory reforms, and that is affecting the exchanges. And it affects us in the way that we need to find new ways to support the companies raising capital, not only via equity. We're seeing the capital requirements hit the bank right now, and that is causing them to be more restrictive lending money to companies, in particular the SME companies. So we see companies coming to the exchange looking for corporate bond listings in order to get the capital they need for the growth and job creation. And I think we are moving in a way where the US market is today. So if you look at the US market, you have 80% equity funding, 20% bank financing. In Europe and Sweden, we have the opposite. But the trend is that we're moving more to 50-50 balance in that context. And the exchange has a key role to play there as well. We launched the First North bond market in December 2012 in Denmark and in Sweden, and we are about to launch it in Finland. And I think that's a good way to show that we're there for the SME companies to raise capital in a bit different way that they've used the exchange before. However, we are concerned about this lack of IPOs we've had in the past few years. There's no doubt about that. And we want to do what we can do to increase the attractiveness for the exchange again. And that's why we initiated a dialogue with market participants in the early 2013. And we're very happy about that discussion and the commitment that the market showed us during these discussions. And we came out, as Alexander said, in September with an action plan where we interpreted those discussions and we created an action list based on what we as an exchange can do to increase the attractiveness of our market in order to support capital raising for companies. We realized that these 12 points will not do the trick fully, obviously. I mean, they will support, no doubt about it, but more needs to be done, both from us, but also from the financial economy, the ecosystem generally, and the policymakers. I think they have a key role to play here. But let me just touch upon a few points on the action plan, which has been talked a little bit about earlier today here. As you can see from the 12-point action list that we have, the focus is on the SMEs. The future Ericsson, the future Electrolux offering. we see that the market since 2007 has changed dramatically for the exchange. We've had fragmentation, we have competition, and that has been a tough market to be a local broker-dealer. And that is important to remember because it has had an effect on SMEs' capacity and possibility to raise capital and become visible in the market. If you look at trading today, or if you look at the listed companies today, more than 50% are a small cap company. But if you look at the trading, the turnover, almost 90% of all the trading activities take place in the large cap. Clearly that affects the broker-dealer. They are then having difficulty finding a business model allowing them to coverage these small cap companies and the mid cap companies. They're having difficulties providing liquidity to these SME companies. That is necessary for SME companies to efficiently raise capital and attract the interest that they need. So what we're doing, we have announced and we're about to launch now in December an intraday auction proposal where we will, during the day, hold trading in some of the companies on the main market, small companies. We will hold the trading for 5 minutes, have an auction, and then restart the trading again into continuous trading. We've seen that being done in Germany, and we've seen it being done in a successful way from the point of view that it's not only a matter of concentrating the liquidity, but actually creating new liquidity in the market. So we will follow that, and we have the intention to expand that into other segments of our market if it's proven to be a successful action also in the Swedish market. On the analyst side, what we want to do, we want to provide a base analyst coverage for our SME companies. So we would find a service to our SME companies without jeopardizing the functioning of the analyst market, without jeopardizing the interest of conflict for the SMEs and us, but a quantitative basis where the investors can get information on this company on our website before it makes an investment decision. Hopefully that would be able to serve as a basis for increased analyst coverage for these type of companies. Finally, I'd like to come back to the policy making part here. I think it's extremely important that we get a more sensible assessment when it comes to regulation of public companies. We have 23 million companies in Europe today, around 10,000 are public. But we see on the policy area a eagerness and a faiblesse for regulating public companies on political issues. I would argue that they are missing the target because it's only a small part of the total company community that are public today. And that is clearly affecting the attractiveness of the exchange as a capital raising market. Thank you.
Thank you very much. And Börje and Alexander, please welcome back on stage, and we will have a discussion. Now, I will soon let you in, and when you ask questions, just press the microphone so we can surely hear you. Now, Magnus, I would just like to ask you, you were giving some examples of your action plan there, and you have other examples regarding, for instance, what we've been talking about also, the quarterly reporting. You're doing some kind of easing in the quarterly reporting for 2 quarters. Could you tell us about that?
Yes. I mean, there are clearly different interests in the market here. I mean, you have the investor perspective, you have the company perspective, and our role is to balance those interests. And we have concluded, listening to both parties here, that the regularity of quarterly reporting is a good thing. But we want to create the flexibility in the actual reporting content. So we are about to amend our rules in such a way that we will just have a management statement as a new requirement. That is in line with what you find in most European countries today, based on the Transparency Directive. However, we will also issue a recommendation on what the exchange believes is a good quality in the management report. And in order to maintain the flexibility based on that recommendation, we will allow the companies to deviate from our recommendation if they are transparent and explain the reasons why they're leaving. In that way, we would be able to manage the vast differences between companies.
So it will be a little bit easier to...
Flexibility is the word, while maintaining transparency, because we're very eager. We want to maintain the confidence of the market and the quality of our company.
Yeah, that's an interesting balance. And another one of your proposals is with the electronic trade, the high-frequency trade.
Yes, I think we've had a debate in Sweden about high-frequency trading, and that has not been a good debate for the exchange. It has hurt us. I think the high-frequency trading, they have some good things with them. They create short-term liquidity, which I think is also beneficial for the long-term investor. But they have certain features to it that needs to be addressed. And we're addressing one of them, that they're placing too many orders per transaction in the system. So we're going to put in an incentive scheme there to decrease the number of orders per trade. So they would have to pay more if they're about 100 orders per trade.
Okay, so more expensive if you place more orders. Alexander, what do you say? We've heard a couple of suggestions in this action plan. Will it be enough to save the Stockholm Exchange, do you think?
Ooh, making projections and predictions, always dangerous for economists. Otherwise, I may be wrong, I know that. So, I think we're actually in agreement on many points. We're certainly in agreement that the listing function of the exchange is very important for the economy as a whole. I think where I might depart a little bit from your analysis is in terms of the long-term sustainability of what exchanges can provide on that score. I think what we're seeing is more than just a cyclical change. It's perhaps in part due to low exchange rates, so lower interest rates and so on and so forth. But there is this argument that the provision of capital and alternatives in general to trading functions on the private side has happened. And it's narrowing the gap between the exchanges and what firms can get domestic. And I think that's not going to go away, that's structural. I don't know how important it is, I don't know how narrow the gap needs to become for the exchange to be at some level irrelevant in the life cycle of a growing, exciting company. I don't think we're there yet. I don't know whether we will get there ever, but I think that's the long-term threat to listing strategy exchanges. And then dealing with, for example, the quarterly reporting and dealing with, let's say, annual coverage, that is very important. So great importance to the companies that are already listed to make them want to stay listed on the exchanges. It may be important on the margin to the companies that are considering whether to list or not, but for them it might be more relevant to think out what can we get at the moment as a privately traded firm. That's the structural change. So I'm all in favor of thinking very hard about what the quarterly reporting should be changed to. Some countries, Germany would be an example, don't think the quarterly reporting needs to apply to all companies, half-yearly reporting, for example. If you're an infrastructure company, it's not clear the quarterly reports are actually meaningful at any level because the time horizons are 10, 20, 30 years and not quarterly cycle. On the research side, I think the innovation is actually happening here, not in the US, which is very encouraging. When we look in the US at what can we do about the fact that there's less research into smaller companies, we're actually looking to what's happening in Europe, in particular to what's happening in Sweden. So lots of initiatives here that might have actually been copied in the US. The US, I think we've given up on that. We're saying that the game's over, the brokers are only going to be interested in large cap stocks, and there's nothing we can do about it because there's no way to pay for that research. That is probably where we are in the US. And there's more thinking about how we can intelligently solve the problem on this side of the Atlantic, which I find very encouraging.
Yes, Magnus.
Well, I'm just listening to my US colleagues on the game is over. On the liquidity side, I don't think the game is over yet when it comes to small companies. We're proud to say that we have convinced our US colleagues to export a Swedish feature that is a liquidity provider for small companies. And that is with SEC now for approval. So that will be introduced on the NASDAQ market. That's one way of supporting broker dealers to provide liquidity to the SME companies.
Yes, Börje.
I was going to say that is an important effort we are doing following the Jobs Act in the US, which actually allows companies. In the US you have a very different situation, a regulatory situation, I think it's worthwhile to mention, is that if you have more than 500 shareholders, you have to register by the SEC. That's a very onerous process. So there's a big threshold. Once you reach 499, the regulatory burden goes up not by a small amount, but by a very large amount. So therefore, in the Jobs Act that President Obama launched, there is a allowance now for having up to 2,000 shareholders, excluding employees. So it's 2,000 outside. That has created a new way or a new type of market and a market situation, which is, it was on your slide, shares closed, but NASDAQ private market is another name for it. And that is setting up a different type of stock market from the beginning again, that I think can serve the function of providing capital to growth companies again.
Oh yeah, I just would like you to comment. Obviously, you're doing some very interesting things. The Stockholm Stock Exchange, and you're fighting back this decline that Alexander is talking about. But Alexander also kind of said that you don't really have the sense of urgency needed for the structural reasons, the bigger reasons. What do you say?
I'm not sure he said that, but that's okay.
That's my
that's what
my rephrasing.
You got a little more attention.
The journalistic phrasing.
Well, I do think I think Alexander is right in the comments about the structural threat. And I think where we have to work is to lower the cost of being listed. And that's where you come into the quarterly reporting, you come into owners' regulation, or detailed political regulation about the way companies behave. I think, the whole idea is that it's supposed to serve a greater good. Right? You, in a way, by raising the standard on the public companies, you're protecting the individuals from being cheated by companies. I think that's the whole notion. But there is a fine balance when you enter into a situation where it's just not cost efficient to be listed. And I think we're approaching that very rapidly. And we have to start to think, this EU Green Book, it was even supposed to regulate how you appoint auditors, how directors are appointed, etc. It's a huge friction cost for companies. So in that world, if I have the alternative of raising money in a private setting or public setting, I have to put that cost into proportion. And I think that cost has gone up dramatically, just over the last 10 years actually. And therefore, I think that is a fundamental reason why we see companies staying away from listing. And unless we change that, I think that we will be under a structural threat. And that's why we see the action plan. Well, we see the rising cost. But that's why I think we need policymakers to start to say, well, we want growth companies that are equity financed. We don't want capital to be the true restriction. We want the ideas to be the restriction. Right? Now we're actually making capital a restriction again, which I think is unnecessary.
So this is actually on policymakers, it's the regulation part.
We need the exchanges, and that's the action program you heard about the quarterly reports. But we need policymakers to get away from dabbling into every detail about public companies.
Okay. So let me ask you what you want to ask the panel. Yes, please, to use the microphone. You can present yourself as well.
My name is Johan Bygg, I come from EQT. Two questions. When I was looking at the statistics there on the shrinking number of companies, I remember when I was with Michael Electrolux here in the beginning of the night, we were listed on 7 stock exchanges because that's how it then worked, and then that has been reduced. I don't know if it changes the big numbers at all, or how big that influence is.
So the numbers mentioned here are just for US companies listing in the US. Because there are some US companies that are never listed in the US, but abroad, but it's a very small share.
If you look at the Scandinavian numbers, I mean, there's an impact on that. And my other question was, do you have a good graph? Because it would be interesting to see, because I think the structural change in society is very interesting. How much of the shares are owned by private people and entrepreneurs as compared to pension funds and big institutions today? Because I think that's a huge shift when it comes to how you have to build governance and other things, sort of, guarded in a different way.
But then about Sweden, but in the US, there's will be a shrinking share. So ever more institutionalized now. For better or worse?
The shrinking share of individuals.
Yeah, exactly.
Or it's the same thing in Sweden. I don't know the number.
Looking at the trading level, it's 10% on the main market, around 15% on the personal retail trading. It's shrinking. So I think that's more passive investment, index investment, versus active investment, which I think is also negative for the SME companies and their ability to attract the liquidity that they need for the capital raising.
And what can you do about it? You raised the issue, Börje, about more individuals coming into the stock market with tax incentives.
I mean, when you listen to the public debate sometimes, I get surprised when we talk about it. It should be tax-free to transfer between funds, but you're taxed if you transfer between companies. Right? So, for example, that type of discussion says to individuals that they should allocate capital to funds, not to keep them in individual stocks. I think that is a big problem, and you see that on First North, where the private investors are much more important. And that's why that is a market that actually has some sort of, or functions by itself.
Yeah.
So I think here we have to think about maybe lowering tax rates on capital gains, for example. If you've held the shares longer term, maybe you should have lower capital gains. Maybe if you've held them for 18 months or 2 years, you can reinvest it tax-free.
Several policy proposals here. Yes, Magnus.
Yeah, 2 points. First off, we see a quite high rate of retail investors. That's a good thing, but it's also a consequence of Swedish legislation, which is not a good thing, because the institutions are limited in their possibility to invest in first of all. This is based on EU legislation, implemented in the uniquely Swedish way. We don't see it in Finland, we don't see it in Denmark. And that, it has an impact because looking at the attractiveness for the bond market, for companies to list a corporate bond in Sweden, the interest is much lower because they cannot attract institutions in the same way they can do Denmark and Finland. That's an important policy point, an important issue for the policy maker. And the last point I'd like to make is not only the tax, lowering the tax for capital gains. I think the treatment of debt financing and equity financing, the difference there between the deductibility for interest rate and how you treat equity is a peculiarity, and I would argue that it should be the same. It would enhance the stability, it would attract the possibility to raise capital on exchanges. And also, I'm not arguing that it should be only for exchanges, but it should be for all the companies, but it would benefit the capital raising function.
Very interesting proposals. I'm meeting the Minister for Finance on Monday. I will bring it with me. Further questions, of course you have. Yes, please.
I'm Leif Windhog. I would like to ask you something about the other side of the coin. Alexander mentioned it and Börje brought it up also, and that is the importance of the equity market to distribute wealth and allow people to participate in growth of wealth in society. Today we can see that fewer and fewer citizens are holding stock. It's going down 13% or something now. And I would like to know from you, what can we do to change this situation? Because already in the Wage Earner Funds report back in the 1970s, it was a crucial point where they said that if you wish the larger public to be part of wealth creation in society, they must be co-owners of the production facilities. And we can see today that there is not enough material. And a striking example could be to say that Ingvar Kamprad used to say that IKEA doesn't need the stock exchange. Correct. But the stock exchange would need IKEA because it's a company where we could park billions of kronor in pension money and individual assets and have them well managed. So that's why one issue I would ask you for, what can we do to bring more of those private companies into the market? You indicated for the US that the larger portion of the companies were actually outside of the market and thus outside of the reach of capital formation for individuals and institutions.
Well, Magnus, what can you do to bring IKEA and other big nice companies into the stock exchange?
I agree with you, Leif, that it's very important. And I think, a couple of points, I think we're seeing more investors coming in now, recently. So the risk appetite is coming back. What can we do to support that further? I think from the exchange point of view, we need to focus focus on confidence in the market, trust in the market, and transparency. And we do that by ensuring that we invest heavily in our surveillance system, competence and so forth, and that we advocate and have rules that are supporting transparency, but in a balanced way, obviously. I mean, that's what we can do from the exchange point of view.
You're investing in trust, you said, and I heard you a month ago, I think, on a financial meeting, you said you were in trust business, you're in trust business. And then I read this one in Svenska Dagbladet. It's an article by Andreas Salenka, I think you all know him, and the heading is, "The stock exchange is soon to become a hall of shame." He doesn't think you actually take enough action to go for these, these companies not behaving well.
Well, I think many of those, I don't think any of those companies were on exchange, if I recall the article correct. So I think that distinction needs to be done. I think clearly we can do more, and we're doing more, and I think the takeover rules are one thing that we need to look at, and we have started a discussion with the self-regulatory entities in there, and so we hope to have a analysis and some conclusions and hopefully some proposals coming up very soon.
Börje, and then Alexander.
I was going to say on the capital formation, I think institutional investors actually participate in the private market. That can happen through venture capital, private equity, or direct ownership. And I think that's where you see the growing portion. So institutions today are allocating more capital into the private world, because that allows them to save on the, call it again, on my regulatory cost of being listed. So in a way, it's the same company from an institutional shareholder point of view would be worth more in a private setting than in a public setting. That's where the whole issue is. And that's why we need to discuss how do we lower the cost of being listed. I.e. that's again, it's the cost of quarterly reports, it's the short-termism, but it's also the regulatory burden that comes up. That's why we have to work on those.
Alexander.
Let me join up the two questions that we've had and think about stock market participation and individual shareholders. I do think it's very important that we have stock market participation by individual investors. Very important for just the credibility of the system that we've got. But the question is, what form should it take? Should it be direct investing by individuals into shares? Or should it be through intermediated vehicles like mutual funds and so on? We think about mutual funds, they exist for a reason. They exist for a reason of very cost-effective diversification and so on. It's a very effective way, if you don't have much money, to put that money into the stock market without being eaten out in fees and so on. So that's one side. The other side of this equation is if we have ever more individuals investing directly in the stock market, what we will get, and maybe this is showing that I spent too much time in the US, is ever more regulation. A lot of the regulation that we have in the US is there to protect individual shareholders from companies ripping them off or doing nasty things to their savings. So if we move instead to a more institutionalized market where individuals invest through institutionalized vehicles, perhaps we can justify having less regulation going forward. That would be a different perspective on the question.
You agree, Börje, that more individuals mean more regulations, more individual owners?
I think it's a pretty interesting argument that I need to think a little bit more about. But I don't necessarily think it has to be that way. Because the regulation becomes almost check-in-the-box nature. And the problem with check-in-the-box nature is you lose the human intelligence. So then we might as well have computers investing, right? Because that's going to be good enough. But individuals actually have passion for companies, they have an interest in the companies, and I'm sure some of the original investors in Apple, they have stayed around. They've owned the shares up to whatever it was, and down to almost zero, and back to 500 or whatever it is. They are truly long-term investors. But I'm willing to bet there are no institutional shareholders that have been there since 1980.
Magnus, you had a question.
Yeah, I also think this opportunity for wealth sharing is very important. And what surprises me is that the technology is there now for people to earn. They run their own pension fund, and we have in Sweden investment accounts, capital pension accounts, where there doesn't cost you anything. You don't have to pay capital gains tax anymore, so you can switch between shares. But I just have I feel that the banks or the large financial institutions, they are kind of, they don't want us to run our own pension funds. And they want us to buy their opaque fund products. And then we're locked into those very expensive products rather than owning directly. And I mean, one thing is corporate bonds, for instance. If you're a listed company, then the share is always more risky than the bond. You can buy the stock, but the bond normally can only buy in 1 million kroner size, because otherwise you need a lot of regulation that costs a lot. Why is that? It doesn't cost anything with modern technology to do it at 10,000 kroner pieces. So therefore, the technology is there to dissipate and share wealth among very broadly, and that's really important, I think, for political support for a liberal democratic capitalist system as we have in the long term. So what do you say about that? Do you think that the banks and other financial institutions are important here in a short-term way, kind of pushing their own interest, but in the long run, of course, it's not good for them either?
Two comments. I think we yesterday had a listing, corporate bond listing, first off with a retail lot to trade 10,000. So I think it's coming. I think it not only requires smaller lots, but it also requires a standardization and transparency that we haven't seen yet in the corporate bond market to the same extent as the equity market. And that's a key for us to create the necessary liquidity and attract retail investment in that type of products, really attract that. And hopefully the MiFID II directive coming out now will provide necessary transparency in those kind of products, so we can develop that market, the secondary market. On the pension side, I just note when I see the market that the competition is increasing, and I expect that to be beneficial for the investor.
Maybe not beneficial for the banks, but it's beneficial for the investor in the end. Yes, more questions, Michael.
I hope you can hear without the microphone. It's actually to Börje's point about the leveling playing field. The question will, of course, which I personally believe is one of the drivers for this polarization. Because in reality, if you think through that after each financial storm, there comes new regulations, and that will probably be so for the foreseeable future. Just thinking about, I'm sitting in two companies now trying to adjust to the British new remuneration report, which means thousands of hours of work. Another company trying to adjust to the Swiss referendums, a huge number of hours. The EU's report on auditors and the whole thing. All these together, of course, shies away companies that don't need to be there really to find other ways. Have you any feeling or any ideas how to cope with this? It will not go away, so let's not dream about it. It will continue, and it will escalate after each storm. And I'm happy I'm not in the banking system. But have you any ideas what can be done to actually make sure it becomes a leveling playing field? Or do you see any trends of politicians or the society reacting to this, hoping that we actually want to have a bigger marketplace?
We spend a lot of time in Brussels because these are very important issues to us, and I think the decision making is very much in Brussels. I think we should forget that we're able to influence the decision making process, and we should do better at that than we are today. I think I understand the political desire to regulate, particularly financial institution markets here. But my impression is that no one really has the overview of the complete flood of regulation and the impact it has. And there is also a trend to regulate mentioned public companies, and I don't understand that to a large extent, why that is important to regulate the 10,000 companies, but not the remaining 22 million so-called companies in Europe. And I think that needs to change if we're going to have a level playing field. Because if you look at the regulation one by one, I think perhaps that will not hit the scale, but in aggregation, this is in long-term beneficial for the function of the public market.
What more and what else can you do without, if we're not thinking about influencing the regulations?
I think the trend has changed. My sense is that the trend, the discussion in Brussels is changing a bit. We're coming into a phase when the focus is more on growth and how can we support SME. Börje mentioned the green paper, long-term financing and long-term growth. I mean, that's clearly a sign that the institutions are trying to find means to support growth for in particular SMEs.
So you can see some kind of trend changing. Börje?
There is an opportunity to see growth of more unregulated markets. We talk about stock exchanges now, but I think we will see the growth of that completely is unregulated. And therefore, that's an opportunity for growth companies to list on. They may take the form of the NASDAQ private market in the US. That's not going to be unregulated, but we have a lower level of regulation that we have been able to create to get a void from the tinkering again, from in the case of the US to Washington. And I think that's what you're going to see in Europe also. We will see emergence of more, or the first more type of market. It's not an unregulated market, but it's a lightly regulated market, and not a true exchange in that sense. That's what we're going to see, and therefore that is the way to grow this. So I think from a business point of view, that's the way we can work on it. But in parallel, I think we have to be much better at influencing the politicians also and talk about the benefits of free enterprises. I was in Brussels yesterday, and we went around to just a couple of different parts of the EU. And all of a sudden, you see everyone talks about regulation in completely different parts. So whether you go to DG Markt or you go to, on the finance side, it's all talking about regulation, and they're talking almost about conflict in regulation. So I even wonder if they talk to each other sometimes.
So what are the reactions you meet when you come to Brussels? It's very popular if you're a policymaker today to talk about regulation, as you have said. How do they treat you when you come with your suggestions?
You come with a lot of enthusiasm, and then you go home. I think this is it's a never-ending battle. We have to continue to work on this. And I think Swedish companies in general, we spend too little time in Brussels. We have to be there much more. We have to be increasingly there. That sets the tone in Europe. And we have to talk about what's good with the Swedish model. And we have to spend a lot of time discussing, we have shareholder-driven board nominations, for example, which is, completely unknown in Europe. So we have to spend time describing that, because otherwise regulation will start to hit on the Swedish model, and I think that's also bad.
Alexander?
So we are, I think, implicitly talking a lot about IPO companies, but that's only half of the story. The other reason why we see ever few listings, certainly in the US, is because established companies opt out of the stock market and let themselves be taken private. So if we lower the listing requirements and regulatory burdens on small emerging growth companies, which is a good thing to get IPOs going, that doesn't do anything for the established companies that are already listed but are reevaluating whether they want to stay listed. So thinking more holistically about what regulation ought to do going forward, I think is an important part of the solution. And then the question, of course, is whether you want to, as you level the regulatory playing field, whether you want to level up or down. And I think I've heard Börje say that he wants to level up in the sense that we should apply some of the regulations that exist to the private company. And I'm not sure whether that's...
Just that is fine.
Good.
More questions? Yes, please.
Yes, my name is Michael Atkinson. We have listened to different reasons that is sort of underpinning the headwinds for the public market. In Sweden, we have a unique feature, that is the Swedish governance model. Do you believe that will boost the attractiveness for the public market, or is it the other way around, hampering the development of the public market?
I think we got a lot of positive feedback in Brussels for our governance model. The nomination committee has been appreciated, and I think our model was, the example of our model was quite instrumental when it comes to Mr. Barnier's eagerness to regulate on the corporate governance side, and we switched into remaining on by respect principle. So I think it's a good model. I think my understanding is that the companies are, after a number of years now, will come accepting it and finding the value in it to a large extent than perhaps initially. So I don't think that's the key thing in attractiveness or non-attractiveness for the exchange. And that is also the reflection we have following the discussions within the IPO task force that we have during this year. It was not raised as something, as a key feature for increasing attractiveness.
So strength, you say, Magnus. So yeah.
I think, Mikael, the jury is still out, if it's a good model or not. I like it. I think it's a great way. I think the shareholders should have the right. But it's a discussion, how do we compose nominating committees, for example. If you think about the Swedish companies today, most of them have more than 50% of the shareholdings outside of Sweden. In a way, with the nominating committees, we're potentially exposing ourselves to very aggressive behavior by shareholders that would focus on very short-term actions. So it's actually very easy to replace a board in a Swedish company.
Alexander,
which is not the case in some other jurisdictions, one should keep in mind. So I think the jury, from a long-term perspective, is still out.
do you agree, Alexander, coming from abroad, looking into the Swedish governance model that I know you know very well?
Not sure whether I know enough about the Swedish governance model to have an opinion on that.
No? So we'll leave that out for now. Last question. Yes, please.
Hi, my name is Carrie Ingram. I'm a doctoral student in Stockholm School of Economics. I'm just wondering, an economist has mentioned that in the US they see crowdfunding, and particularly equity crowdfunding, as a really viable alternative source of capital, particularly for SMEs. And of course equity crowdfunding is already here in Sweden. And I'm just wondering, from the capital market perspective in Sweden, have you seen that as a kind of viable alternative among, I don't know, your business interactions, and do you foresee it becoming a viable alternative or a challenge to capital markets?
Equity crowdfunding. Alexander, you start.
Yeah, let me just very quickly say, I'm not sure whether it is a viable alternative yet. It might at some point become one, but this is the very early stages of this. And I have some trepidations about it. You can easily imagine widows and orphans losing their money when they invest in private companies that are extremely badly regulated, back to regulation. And when that happens, when widows and orphans lose their money, we will have re-regulation of this market. That's my prediction. So I'm not sure we're there yet.
Magnus and Börje, do you see anything on this happening here?
I think it's already raised in Europe, this topic. There's been increase of it in volumes. I think I agree with Alexander that at some point some sort of regulation is coming into play on that type of financing. But if it survives that regulation, I think it has a function to play in the capital market.
It's time for us to close this seminar, and finally I would ask you a very, well, it's not an easy question, but it's a very short one. A lot of companies, or several companies, are coming into the stock exchange, the Stockholm Stock Exchange coming, I think the first one is tomorrow, right? Yes, it's Platzer, and a couple of other ones coming along. If you were to guess, how many IPOs on the Stockholm Stock Exchange next year? Magnus. Alexander. Yeah.
I start with that 10.
Okay, so yeah.
I always just stole my number. I go with 15.
And Magnus.
I did more optimistic. We have 30, 35 in pipelines. Not all of them will come to the exchange, but I did the most optimistic among the customers.
30, 35, that's
In the pipeline.
in the pipeline. So maybe we should change the heading for ending this seminar from the decline and fall of the stock market to the decline and fall and revival, of the stock market. Alexander, Börje, and Magnus, thank you very much for coming.